All right. Good morning, everyone. On behalf of the Mass Mortgage Bankers Association, I would like to thank both Fannie Mae and Freddie Mac um, for allowing us to be able to offer this as part of our affordable lending summit. I can't think of a more important part of our summit than to get updates and an overview of both what Fannie and Freddie are offering for affordable lending products and programs. So we are going to start off with this morning, we're going to start off with Freddie Mac. And we have Brian Culhane and Lori Kiesel. And I am going to turn it over to them, and we will be seeing Robert and Anita a little bit later on. So,
All right.
Brian and Lori, do you want to introduce yourselves and
Sure.
take a minute?
Absolutely. Can you hear me okay, Debbie?
I can.
Great. Well, thanks very much. And thanks to everybody who's attending and joining us this morning. So I'm Brian Culhane. I'm a sales director in our affordable area. And I've been with Freddie Mac for about 37 years now. So it's been a good long time. I'm starting here shortly after moving down from Rhode Island back in 1986. And in fact, I just made it back to Rhode Island last week for a few days. And so I currently manage a team that is focused on working with you, our lenders, customers, and directly with our sales team on a variety of affordable products, programs, and initiatives. And that's what I'll be talking about today, along with my colleague, Lori Kiesel. And so, Lori, let me kick it over to you to introduce yourself.
Thank you. Good morning, everyone. Very excited today to be here. I'm Lori Kiesel. I'm on the Affordable Lending Sales Solutions team. So I work for Brian, and as he said, we work very closely with your account teams. I know we've talked with a number of you on the call today. So very excited to share some information around affordable lending in the New England area and how we can continue or begin to partner and really make sure that your market uh, is being served and that you have the support of affordable lending opportunities. So, Brian?
Thank you, Lori. So Lori's going to drive the deck. Lori, I was thinking maybe I just beep like an old film strip sort of thing, so you know when to go to the page. But after slide 93, that might get a little tired. So I'll just give you a little cue then to go forward. Um, so our approach today, as Lori's bringing that up, we're going to touch on a number of topics, and we don't really have time to deep dive. This isn't designed as a training. We just want to introduce a number of you to the various solutions, products, programs that we have that can help you serve your customers in your markets. But we've designed this deck so that it can serve as reference material for you after the call as well. So if it feels like we're touching on a lot of things in a short period of time, good, that's our goal. And then we will follow up with questions, and then we have our various teams and resources available to you after the call as well. So,
May I just interrupt for a moment and
yes.
just remind people that if you have a question, you can input that in the chat section and we'll get it to either during the presentation or afterwards. Thank you.
Okay. Thanks, Debbie. All right. So let's get into this. So just by way of introduction, we see here the ecosystem, and we're all familiar with this. It takes a lot of different people with different areas of focus, different subject matter expertise to make all of this work. And that's why Freddie Mac talks about this often as all for home, to bring all of these resources together. And what we found is that those who are best at bringing the various pieces of this ecosystem together, the various resources available, inevitably will do the best with respect to being able to meet the needs of more home buyers who might need that certain extra something in order to get into a home. And if you go on to the next slide, please. Yeah, we know that these potential home buyers are facing a lot more significant headwinds today than they have in many, many years. And we've seen it in the news, we've seen it in the markets, we've seen it in the people that we talk to every day. The lack of affordable housing stock, high interest rates, the highest interest rates in decades, prospective home buyers lacking funds to be able to afford their down payment and closing costs. And so how do we address this? How do we help these folks be able to get into that home and achieve that dream that they have? So Freddie Mac starts with its foundational affordable mortgage programs. And it's not, again, not training, not going to get into a super deep dive here, but want to be able to touch on all of these with you. And so before we even get into that, I want to spend a moment to review a few key acronyms. The mortgage industry loves its acronyms, and Freddie Mac takes that love to some very uncomfortable new highs. We have so many acronyms, and there are a couple key ones here that we'll be referring to from time to time. So one is VLIP, which stands for Very Low Income Purchase, and that refers to borrowers whose qualifying income is less than or equal to 50% of area median income for where they're buying their home. And then there's LIP, which refers to those borrowers whose qualifying income is less than or equal to 80% of area median income. And so that does apply in certain circumstances to things we'll be referring to here. So I just wanted to cover that at the outset. So with respect to Home Possible, right? So that's our one of our key foundational products. It's designed for first-time home buyers, but not just first-time home buyers, can be other buyers as well, who qualify based on that area median income at 80% or less of AMI. Okay, down payment is as little as 3%. There are a number of down payment and closing cost funding options, which we'll be touching on in a moment. And it allows for co-borrowers who are not necessarily part of the household, not necessarily living in the home. Following on this, we also have Home One. So Home One is specifically for first-time home buyers, but it's there for borrowers whose qualifying incomes are greater than 80% of area median income. All borrowers must occupy. It's a fixed rate mortgage only. And we'll get into some more details on Home One in a moment. And then the third foundational product that we'll be talking about this morning is HFA Advantage, which is here for use in conjunction with housing finance agency programs. It's based on Home Possible underwriting and incorporates state and local down payment assistance available through these HFAs. And it also provides much greater income eligibility flexibility. So let's look at each of these products a little bit more closely, and we'll start with Home Possible. Without going into great, huge amounts of detail here. And again, this deck will be made available to you, and this is being recorded, so you can refer back to it as needed. But you'll see reference here to maximum LTVs, TLTVs up to 97%, 105% with use of an affordable second. And we'll talk about that a little bit later. Can be used with adjustable rate mortgages. Not a great ARM market with the inverted yield curve, but you never know. Someday ARMs might come back. Can be used also with no cash out refinances. Again, not a great market for refis, but there will come a time where borrowers who are purchasing those homes today will have that opportunity to refinance, and you will be able to use Home Possible with them in the future. And then with respect, I want to call out a couple of other things here. Mortgage insurance. We do allow for lender paid single premium MI with Home Possible, as well as the finance single premium MI. So when you are doing that, that's the sort of thing that can also help with affordability in terms of addressing potential cash flows or asset availability issues that a home buyer may have in order to get that mortgage insurance paid for right up front. Let's move on to the next slide, please. So, what's even more key here than just the product specifics is when you get into borrower benefits. So how is this really helpful to the borrower? That 3% minimum down payment and TLTVs up to 105% is just absolutely huge with respect to helping out at a time when borrowers may be scrambling to assemble the cash needed to make that down payment and pay for their closing costs. The cancelable private MI after reaching 20% equity is a great feature, especially when compared to the limitations or requirements placed on MI for the government programs. It's not limited to first-time home buyers. So anybody who falls into the qualifying income categories, even if they already own a home or have recently owned a home, can qualify for a home possible mortgage. There's no minimum borrower contribution from first personal funds, and we'll talk a little bit more about other sources of funds in just a moment. And it also allows for non-traditional credit. So let's move on to the next page here as we get into a key piece of a borrower benefit, and that's the Home Possible VLIP credit. So with let's see where here we are. So we announced this in February, beginning of February, where for Home Possible loans, so they have to be a Home Possible loan for those VLIP borrowers. So again, those are those borrowers whose qualifying income is less than or equal to 50% of area median income. Freddie Mac will provide you, the lender, with a $2,500 credit that needs to go to the benefit of the borrower that can be used toward closing costs or toward the borrower's minimum 3% toward that down payment. This is for loans sold to Freddie Mac at the beginning of this month, March 1st, and is good through February 28th of 2025. So you could begin originating these loans immediately. It can also be used potentially with VLIP borrowers getting an HFA Advantage loan. You would need to consult with your local HFAs with respect to availability of that. It's really important to remember on this. It's not an automatic for all VLIP. They have to be originated and delivered as Home Possible loans in order to get this credit. And also very important to remember the money has to go to the benefit of the home buyer, to the borrower. But also important to realize this money can be combined with other sources of down payment assistance. So taking in all those pieces of the ecosystem to the extent you and the borrower are able to identify and leverage other resources, this can just contribute to all of that. So let's talk a bit about other eligible sources of funds, because we've mentioned it briefly going through. I'm not going to go through this point by point, but there's a ton of flexibility here, right? There's a lot of opportunity to access funds, and we know that not every borrower is the same. They don't all have all of these resources behind them, but there is opportunity here. So there's a lot that can be explored as you're working with your customers, with your home buyers, to find, well, what might they have, what access to resources might they have that will help them get into the home. And beyond even just borrower personal funds, if you go to third-party funds that are available, other eligible sources of funds from those third parties, whether it's gift funds or gift of equities from a related person, could be a wedding gift, could be a gift or grant from an agency, which if you're not familiar with that, it is a defined term in the Freddie Mac guide. Could be a gift or grant from sellers as originating lenders. So refer you to the Freddie Mac guide for the rules on that as well. Affordable seconds. There's just a lot of opportunity here as well. So, take some time to the extent you're not familiar with the flexibilities here, and by all means, you could reach out to your account executive, whoever's supporting you on our sales team, and Lori and Jim Hall also available to help address any questions you might have about some of this. So if we move on to the next slide, I'm going to talk a moment specifically about affordable seconds. So affordable seconds basically allow for the financing of closing costs or down payment assistance. And there's some specific rules about what affordable seconds can or can't be. But one key thing I want to point out is that depositories, who are our sellers and who are also originating these loans, can provide the affordable second. So the guide allows for banks and credit unions to do this in conjunction with Home Possible loans. So we went live with this in early 2020. It allows for those total loan to values up to 105%. The second could be forgivable, or it could require a repayment. It can have an interest rate as long as it's not greater than 2% over the rate on the first lien mortgage. And the size of the second would be entirely up to you. It's based on your budget, if you want to create a program, and what you identify as the market needs for your customers, and what the opportunities might be to deploy such a program. Okay. So this next piece here I'm going to speak to a couple of times today because it applies in a few different places with respect to the affordable lending business that you might do with Freddie Mac, and that's this concept of credit fee caps. And the intent here is that we're able to eliminate most of the upfront credit fees and price that we charge for certain first-time home buyers, low-income borrowers, and underserved communities. So there's three basic credit fee caps. For first-time home buyers, where the first-time home buyer has a qualifying income up to 100% of AMI, and it could go up to 120% of AMI in designated high-cost areas, of which there are some throughout New England. More generally or specifically, for home possible mortgages, any home possible mortgage where that borrower qualifying income is less than or equal to 80% of AMI. And then also for certain duty to serve mortgages with qualifying income up to 100% of AMI. And we'll talk more about duty to serve in a few moments. That area median income percentage, again, is calculated using borrowers' qualifying income, not total household income. So it's an important distinction with respect to working with Freddie Mac versus other programs that might be available in the market where there's a focus on household income. So just something to keep in mind. And yeah, by all means, refer to our guide exhibit 19A with respect to getting more details with respect to the credit fee cap eligibility criteria. Okay. So let's go on to Home One. Okay, so let's spend a moment more on this. So again, Home Possible covering the borrower incomes 80% or less of AMI. Home One greater than 80% of AMI still allows for 3% down. There are no geographic or income limitations. There's no cap on income. So the idea here is to help first-time home buyers who have more cash flow, but may need more assistance with respect to that down payment. And where getting 5% down may be a bit of a stretch, 3% down helps get them into the home. So, it's a great solution for helping out that borrower segment. And it works simply and seamlessly with Loan Product Advisor or Loan Advisor. So moving on to our next slide with respect to benefits. I mentioned the down payment challenges, the broad access. It's also worth pointing out the homeownership preparedness, right? So for both Home Possible and Home One, if you have a first-time home buyer, we do require home buyer education, not necessarily home buyer counseling, although home buyer counseling would satisfy that requirement. But there is a home buyer education requirement to try to, as much as possible, ensure sustainable home ownership for that home buyer. And we would certainly point folks to Credit Smart University as a super tool that you can provide to your customers who need that education, and it is free. So something that we encourage everyone to look at and take advantage of. I see that there's a question in the chat now, Debbie, and I see it came up on affordable seconds. And since we just talked about that, but I can't see the entire question, so I thought
I
maybe we could
can.
address it. I thought you might be able
I
to.
can.
So
Here it is.
we're gonna do this as a breaking news thing.
Okay, breaking news. Can the lender affordable second be the only down payment into the transaction under Home Possible? Example 97 slash 100, when 3% is from the lender
Mhm.
funded second, or does the borrower need 3% of their own funds into the transaction?
That's a
Good
great question.
question.
Yes, love that. Thank you for that question. So the answer is that the affordable second can be the full 3% would be required from the borrower. The borrower does not need their own 3% on top of that affordable second. So thank you for that. That's great. Okay, so let's move on past Home One. And I'm not going to spend time on this slide, but want to point it out to you. It's just a comparison slide across a few key features for Home Possible and Home One. And I told Jim Hall I'm going to do some shout outs for him. And I know, Debbie, we're working with you and Jim to see if we can provide some more deep dives on these products where Jim is absolutely a tremendous subject matter expert. And we're looking forward to an opportunity to have Jim spend time with all of you at some point later this year, whenever we can get that scheduled, to really get into the weeds on this stuff, because he'll have some great insights to be able to share.
Thank you, Brian, for the shout out, and I'm looking forward to partnering with Debbie on a future date, like you said, for a deeper dive into Home Possible, Home One, and HFA Advantage. So, thank you.
So yeah, we didn't spotlight Jim right out front, but Jim is, another critical resource, our affordable lending manager, in support of our New England market. And I know many of you know Jim from working with him, or may know Jim, and just another great person. We enjoy being able to work with him and everything that he brings to the table. So HFA Advantage, it's rather remarkable. The product popularity for HFA Advantage has grown significantly. And we're very happy to be working with our customers and with the HFAs to promote affordable housing opportunities around the country through these programs. We're working with multiple HFAs in New England today, including Mass Housing, Rhode Island, Connecticut, and Vermont. And so shout out to all the folks in those organizations and all the work that they're doing to help make Home possible through their various and sundry programs. I wanted to call out a few key recent updates to HFA Advantage, including 95% LTV 105 TLTV maximums on 2 to 4 unit properties, allowing for non-occupying co-borrowers, and allowing manufactured homes up to 95 LTV TLTV. So there's some great stuff going on here. And would encourage folks to take a look at the opportunities and working with your HFAs and Freddie Mac to help meet your market needs, your customers' needs. And along these same lines as HFA Advantage, we also have this great tool that we're introducing. And Lori, if you'll go to the next slide, there it is, Freddie Mac DPA1. So we've started rolling this out toward the end of last year, and the idea here is to provide one location that sort of optimizes the utilization of various down payment assistance programs across the nation, and that would drive incremental loan origination by connecting those that need down payment assistance with those that offer the programs. So it's bringing you, the lenders, counselors, borrowers, the whole ecosystem together to find where those programs exist and how they can be made available to your customers. And key here is that we're introducing this product and on a state-by-state basis across the country over the course of this year. So think of this as a movie trailer, and coming soon to a lending office near you, where we'll be including all of the states in New England to be featured in DPA1. So I know there'll be a lot more info coming from your sales representatives and from Jim and Lori and others as we do this. And we're also highlighting introduction of additional states through marketing campaigns and so forth. So if you get those Freddie Mac email alerts about news and new things coming along, you will see as new states are added and when states that you serve may become available on DPA1. So stay tuned for more there, because the year's going to go by very quickly. We're already the end of March, and so it'll be coming soon to your markets as well. So we're going to pivot briefly here on to special purpose credit programs. So thinking again about our foundational products, and then thinking about how do we also help better serve the needs of minority home buyers in our markets. And so special purpose credit programs have become an increasingly available tool or product around the country in order to do this. Freddie Mac has its own program, Borrow Smart Access, that is available in 10 metro areas around the country. And then we're also working with a number of lenders who have created their own products and programs. And we're able to support some of these programs. And there are some lenders who have developed programs that are really more intended for their own portfolios. But at the end of the day, it's really all these programs are designed to drive greater support for minority home buyers. If you have a program or are interested in potentially starting a program and are interested in understanding of whether the program could be eligible for sale to Freddie Mac, please reach out to your Freddie Mac representative, and we're more than happy to have conversations with you about these programs and how we may be able to provide some liquidity to you with those programs. So now we're going to talk a bit about duty to serve. So I know sometimes that can be a loaded term, right? Because if you just see duty to serve, it may invoke certain images that are not exactly what duty to serve means in the mortgage GSE space. And I know some of that confusion may come from the idea of duty and serving, and people think, oh, it's military, it's current folks who currently serve in the military or who have retired from military service, or perhaps they're first responders. And while there are a number of mortgage programs around the country that specifically focus on our military, those who serve today, or veterans, or on first responders, duty to serve means something very different in the Freddie Mac space. And what it's basically about is reaching and supporting markets that may not otherwise get the amount of attention that they truly deserve in order to thrive. So there are three key planks to a duty to serve plan that Freddie Mac has to create and implement every 3 years. And those three key areas, easy for me to say, are manufactured housing, rural housing, and affordable housing preservation, which would include things like shared equity and renovation lending. And so we have a number of products on which we focus to support our duty to serve these markets, and which allow us to work more closely with you to serve those markets. So we'll start with manufactured housing. A few good did you knows here. 22 million people in the United States live in manufactured homes today. So that's a lot of folks. Manufactured homes cost significantly less per square foot than site-built homes do. So with respect to affordable housing stock, they're a critical component of having that affordable housing stock be available. They can be constructed quickly and efficiently in factories, moved to site, put on their foundation, and they're ready to go. About 2/3 of manufactured homes are actually on privately owned land, the other third being in manufactured housing communities. And manufactured homes are also being used as urban and suburban infill, and the quality of these homes is quite often exceptional. One thing that we did at Freddie Mac a number of years ago is we had our sales team together, and we toured a local retailer and got folks an opportunity to see a number of manufactured homes at the retailer location and get a sense for how they were constructed, what they looked like, and so forth. If that's something that you haven't done, I would highly recommend it. If you have a retailer near you, somewhere you can go check the homes out, because there's some wonderful construction, and I think it's a seeing is believing thing, getting past perhaps perceptions that we have in our mind of manufactured homes in the past. Some really good quality homes being built. From a rural housing standpoint, 90+% of the United States is considered rural, and there's certainly huge rural sections within the Northeast. But having said that, not surprisingly, less than 25% of Americans live in rural areas. More than 60% of rural homes are at least 30 years old. There's certainly a pressure on incomes in rural markets, as 30% of those rural households earn less than $25,000 a year. And also with respect to Native American communities, with respect to financial institutions, only 14%, with significant lack of access to ATMs and having to travel significant distances just to access a bank. So there's a huge need for support in rural markets as well. And with respect to affordable housing preservation, of course, heating and cooling costs, huge. My folks had oil heating. Yeah, it's no fun. My brother would complain about his oil heating bills all the time in Rhode Island. And it's like, yeah, it's high cost, and it is, and it certainly contributes to pressure on home ownership. So there's a lot more pressure today also for states to become and homes to become more energy efficient. And I'm impressed, the few visits I've been able to make to New England recently, the number of solar farms and homes with solar that where they've been putting that on either new construction or on existing homes. So it is impressive to see how the uptake on that has been in different neighborhoods. I'm going to move on from this because I know we're going to run short of time here, and I want to spend a little bit more time on the products themselves. So with respect to renovation mortgages, we have two key ones, Choice Renovation and Choice Reno Express. So this really gets to that affordable housing preservation. It addresses and can address things like energy efficiency. It can be used with both purchase money loans as well as a refinance. I know, not a ton of refinance loans in this market given where interest rates are. It is a great opportunity to engage your customers in a way that might get them to the home they want and help them to afford right from the outset, improving the homes and making the upgrades to the homes that would make it that much more comfortable for them, make it their forever home, or if not their forever home, at least improve sustainability for them in their home. So with this product allows for renovations to allow for rebuilding. It does not allow for actual like complete tear down and rebuild. You'll need a new construction loan for that. It can finance a wide range of home repairs and improvements, right? It's not just limited, and it can be big and it can be small. It doesn't have to be, huge amounts of things. You could have a home buyer coming in and saying, "I just want to replace the windows. The windows are all single pane, and they're drafty, and so we're going to put in better windows right from the outset." So it could be a very targeted usage as well. Wanted to touch base quickly on sweat equity as well. It fits into the renovation space. It is something that Freddie Mac allows for. If you have home buyers who have construction skills, they can use the time and energy that they have, the talents that they have, in lieu of cash for down payment and closing costs, and that can count toward up to 100% of their down payment requirement. I would encourage folks who are interested in looking into this to consult the guide. There are very specific requirements about how to track home buyers' contributions of their sweat equity so that it can be appropriately accounted for and monetized with respect to their going toward their down payment. But there's some very capable folks out there, and to be able to turn their time and energy into money this way is just another fantastic option with respect to helping folks get into their homes. ADUs have also become a huge point of discussion around the country recently. So accessory dwelling units, right? So it's how we help family members have housing by taking advantage of space that may exist on a property. So you could have a converted basement space. You would treat it as an apartment. It could be an above garage unit. It could be something that you're adding on. You've got a large enough land, you can actually build a new structure, detached structure on that home slot. There are certain requirements to be met to qualify as an ADU. It has to include a kitchen, has to have a separate entrance. It has to contribute less to the value of the property than the primary dwelling unit. It needs its own bath, and would be subordinate in living area. So something that's really getting a lot of attention. I know there's a lot of discussions around the country with respect to zoning and how to accommodate these. And Freddie Mac is also able to accommodate ADUs through choice renovation. And please reach out for more details on that. In addition to the Choice Renovation product, we have Choice Reno Express. So for Choice Renovation, if you want to sell those loans to us today, during the renovation period, it's a little bit more complicated. There's a term of business we have to provide to you. There's recourse requirements, and it can cover up to a significant amount of the renovation work that the borrower wants to do. But if you have a borrower who has more limited dreams or needs with respect to doing renovations on the home they're purchasing, Choice Reno Express is an easier way of doing it. It can allow for up to 10% of home value in most parts of the country, up to 15% in high needs rural areas. So it really takes care of those small need situations that you might have. So also, and no separate term of business is required. So it's a great add-on, a great option to include when you're talking to your home buyers about, hey, what might you be interested in doing to your home that you could take care of right now at the offset and not have to wait and try to finance renovations separately down the road. Green Choice mortgages are all about energy efficiency. They basically fall into a couple of categories. One would be energy upgrades to a home that you are purchasing, an existing home. It can also be done as a refinance. Again, not a lot of refinances occurring at this point in time. And Freddie Mac does provide a $500 credit on delivery of Green Choice mortgages to us. There's also an element of Green Choice that allows for refinancing of solar panel debt, solar energy debt into the first mortgage. Again, not the greatest economic environment for that, but as you're thinking about how to help with your borrowers and just go beyond the concept of green, we're talking about saving money. We're talking about being more efficient with cash flows, more efficient, both today and in the future. And this is a great tool that can be used towards that end. So I want to call in credit fee caps again here. And we saw this slide earlier, but I want to focus on that third bullet around duty to serve mortgages. So when we're talking about manufactured housing loans, when we're talking about loans to support rural lending, when we're talking about loans that support shared equity, maybe it's a community land trust type mortgage, those credit fee caps apply on those mortgages as well. Again, borrower qualifying income up to 100% of area median income. And then, so we talked about products, we talked about programs. So how do you get all that to us? At the end of the day, it's the technology that makes the connection between the business you do and Freddie Mac. And so with that, we have Freddie Mac Loan Advisor. So just calling that out to you, when you are evaluating a loan through Loan Product Advisor and you are wondering, well, gee, I wonder if this would be a Home Possible loan. There's messaging available that will call things out like that. Like we'll put it right at the top of the screen. Hey, you know what? This could be eligible for Home Possible. You should evaluate this through LPA as a Home Possible loan. So do spend time looking for those messages and finding those opportunities, because when you do find those, it can then empower you to take advantage of those credit fee caps. It can empower you to take advantage of that VLIP Home Possible $2,500 credit. So, taking these tools and using them together does make for a better all-in execution for your customers. And then also wanted to call out our automated asset income and employment tools. More information around these AIM capabilities are available through our AIM webpage. And when you get this, there's that link at the bottom of this page. So resources, we've got great resources. We've got a tremendous sales team supporting New England. Trina, who's on the call with us today, and Jen Roach, Jim Hunter, Robin Cox, Justin Latvinas, Zena Durrell, Emily Davies, Lisa Butterworth, just a great group of folks. Hopefully those names are familiar to you, at least some of them that you're working with. Lori that you see on screen here, Jim Hall that's been on with us. And I also want to call out Freddie Mac's customer contact center, 1-800-FREDDIE, also available to you with any questions that you might have. At the end of the day, you are, as the lenders, as those serving these markets, you are that critical link. You're the folks that can make all this happen. We're here with our products, programs, resources to help facilitate that for you. And we are here to help. So please reach out to us whenever you need that assistance. So with that, Debbie, I think we've covered what we're going to cover. I think we're about at time. I don't know if there's a couple minutes for any other questions that might have come up, but otherwise we could kick it over to our friends from Fannie Mae.
Let me unmute. It always helps
There
when
you
you're
go.
unmuted. Now, I've got a couple of questions. Do you want to answer them now or at the very
Sure.
end?
However you would like. You are our master of ceremonies, so.
Oh, wow, that puts a lot of pressure on. Okay. So I'm going to ask you, there was a question that we got for Home Possible VLIP. So you mentioned a $2,500 credit. So
Yes.
exactly how do you enter that into LPA?
Great question, Lori. I'm going to kick that one over to you because I know you've been getting that question directly quite a bit.
It's a critical question, so thank you. So that $2,500 can be used for down payment assistance, closing cost assistance, or it can be split. So whatever your borrower needs, what you'll want to do in Loan Product Advisor is enter it in to borrower assets as a federal agency grant, and then and run the loan through Loan Product Advisor as Home Possible. When it comes time to deliver that loan, you'll want to, in Loan Selling Advisor, again, select the loan program identifier of Home Possible and the investor feature identifier of K10. And that combination of Home Possible and K10 is what will trigger that $2,500 to come back to you. You'll see it right as a credit fee credit to you on your purchase advice.
Wonderful.
And we do, I'm sorry, Debbie, I just wanted to also mention, we do have a job aid that walks through Loan Product Advisor, Loan Closing Advisor, and Loan Selling Advisor, and we'll include that link with the deck.
Perfect. All right. So this might be a question that I'm going to end up asking Fannie Mae too, but what about temporary buy downs? Are they allowed? Are you seeing them in this environment? What do you think
Sure.
about?
Yeah, so I mean, so temporary buy downs are definitely allowed. I'll kind of defer to my the go-to, which is make sure you understand how the guide is written. Go to the guide for information on the do's and do not do's with respect to temporary buy downs. When we do see them, they are out there. It is a way of helping borrowers with cash flow challenges right up front, even if to the extent you're still underwriting them at the full note rate, right? Yeah, I'm thinking back to my first mortgage that had a 2-1 buy down. So I certainly, for my first home, that got offered to me, and it was incredibly helpful. So yes, yes, and yes, and please refer to the guide for more details with respect to how to deploy that.
And then I'm going to ask you one question because I am curious about it. You had mentioned that lenders, if they have a savings account program, that is eligible to help borrowers um, with their down payment. I know from legislatively, there's a lot of talk of down payment assistance and in establishing first-time home buyer savings accounts that people can match and things like that. So I think we're in an environment that we're getting very creative as far as
Yeah.
how do we help borrowers kind of overcome that down payment closing cost lump. So are you seeing that more? Do you have any problems if there's, a first-time homebuyer savings match, somehow using that towards your down payment?
Sure. So we don't. The key again is to ensure that the programs meet whatever the guide requirements would be. So the way our guide is written today, we are requiring 3% in from borrowers' own funds. If a lender is providing dollar matches to that, currently as say it's like as a lender grant program, that would come after the borrower's 3%. So you could have that match, and we have seen some of that in the market. I wouldn't say that it is a huge has a huge presence, but there are certainly some lenders who are looking at some sort of savings match element to encourage their borrowers, so that the borrowers have that skin in the game, right? Then that contributes to sustainability while helping the borrowers sort of optimize what they're bringing to the table when they're closing on their home.
All right.
And Debbie, if I could just add to that too, you're absolutely right. We're seeing a lot of creativity in a positive, prudent way in the marketplace. We saw a lot of it in 2023. I think we're going to continue to see a lot of it in 2024. So if you see something in the marketplace, or as Brian has said on a few of our products through the talk this morning, if you're considering something, please feel free to reach out to your account teams, reach out to Jim Hall, reach out to me. We would love to see what you're considering, what you're seeing in the marketplace, so that we have an opportunity to figure out if and how we can support that.
Perfect.
And I know a number of you have already, so thank you very much.
Yeah.
And then I think one final question, although it wouldn't surprise me if I also asked this to both of you, both organizations, but agencies. How do you source wedding gift funds?
As long as they are deposited within 90 days of the wedding date of the event, so this also counts for graduation gift funds, and as long as no single um, gift is more than $1,500, you don't need a gift letter. You'll see the bank deposits is what we're really seeing. But again, if you're seeing something a little off, uh, give your account team a call, give 1-800-FREDDIE a call. Our underwriters in the contact center are amazing. They have years, decades of experience, and they're very good at finding solutions.
Wonderful. All right. So I know that we could also, at the end of this, get back to you with additional questions, but I just wanted to thank both of you for being here. And I know you're going to stick around.
Mm-hmm.
So thank you so much.
Thank you.
Thank
So on
you.
that note, I am going to add a spotlight and remove a spotlight. There we go. And I am quickly going to. Okay, so what did we decide about Anita? Is she spotlighted or not? No?
Looks like she's
Yeah, you
shaking
can
her head, yes.
yeah, you can spotlight
Yes?
me.
Oh, wonderful. I didn't mean to put pressure on you, but let's add a spotlight.
It's
Perfect.
probably it's probably a good thing it takes my head off the the center of the screen. I know there's a little glare this morning, so that's probably a good thing.
No, stop it. So we are so fortunate to have both Robert and Anita from Fannie Mae. And I'm wondering if you would just, do you want to take a minute and just tell us a little bit about yourselves? And, as far as your role at Fannie, or do you want to add anything?
Yeah, sure. So thanks, Debbie, and thank you to the Freddie team for getting things kicked off. Full disclosure, I lost the coin toss, so I get to go second. But that's how it works with the GSEs. There always has to be one that will kick things off, and then somebody to swing cleanup. So my name is Robert Sowers. I'm a relationship manager at Fannie Mae. I work on the affordable lending team. I work very closely with and support housing finance agencies as well as community development financial institutions. So those are HFAs and CDFIs. As Brian had pointed out, like we love acronyms. So Fannie loves them just as much as Brian. I think it's a Washington thing. So I'm going to do my best to spell out a lot of the acronyms today. So please be patient. A little bit about me. I've been with Fannie Mae only 5 years, so I'm a little bit of a newbie at Fannie Mae. However, I have been in the mortgage industry almost 25 years. When I started, I had a full head of hair like Fabio, but this is what I'm going with today. So I started as a loan officer, then I moved up through the ranks on the operations side, and then lastly, I spent significant time in correspondent lending before joining Fannie Mae. And then since joining Fannie Mae, I've had various roles under duty to serve, focused on increasing liquidity in our rural markets and with small financial institutions. And now, I get to work with community-based partners to help execute on our affordable housing objectives.
Thanks. And I'm Anita Zayas. I am a credit risk manager and support Robert in the affordable lending team. I've been with Fannie Mae for probably about 11 years, held different roles in the QC world and also our selling guide support team, which is also a great resource for our selling lenders. And prior to that, mainly background in underwriting. So that's been in the business for probably about 25 years. I don't know. I think I stopped counting a long time ago. So it's you end up here in this market and just stick with the mortgage business, right? So anyway, thank you, everyone.
Can you all, and I'm sorry, I should have done an audio check before I started. Can you hear me okay? I had my audio split. Technology is a blessing when it works, but we all know it's a curse sometimes when it doesn't work.
I think we can hear both of you just wonderfully.
All right, perfect. All right, so let me share my screen. Then let me know. Bear with me here one moment. Forgive me. I may be having some technical issues. Give me one moment. I am. Okay. Sorry, I'm driving today, so I'm not used to Zoom. Let's see if this works. All right, can you see my deck?
I can. You
All right,
are
perfect.
great.
Awesome, thank you. Usually I have my 12-year-old. She's like my chief information officer, and she drives my technology, but she is in school, so obviously I'm on my own today. So before we get started, we talked a little bit about myself and Anita, but also before we get started, I wanted to thank Debbie and the Massachusetts MBA for this opportunity. We're thankful to be here to talk with all of you today. And again, I wanted to thank Brian and his team for kicking things off. So there's going to be some similarities in the things that Brian had gone over with everyone, and also what I'm about to go over. There will be some differences, but I'm going to do my best, to keep everything at a high level, and just go through the various products and resources that we have here at Fannie. So before we get started, this is a disclaimer that if there's any discrepancies in any of the material that I'm about to go over with you today and the guide, Fannie Mae's Selling and Servicing Guide are the official statements and the policies and procedures. So now that we got the legal mumbo jumbo out of the way, I'm going to focus on today's agenda. So for our discussion, I'm going to spend some time on our affordable products, how these can create more options for you and for your borrowers. And then I'm going to shift over to the technology side of thing, specifically desktop underwriter, and the various enhancements and innovations that we've been doing to improve access to credit. So as Brian alluded to when he started, and I'm going to cover a lot of the challenges as well. We all know the challenges that are facing today's market, right? Affordable supply shortages, which seem to be top of mind for a lot of folks, but there are also challenges with access to credit for low to moderate income borrowers, and then the rising cost of just not only buying a home but sustaining a home. So in today's session, you'll see the steps that we're taking at Fannie Mae to help address these challenges. So as you all continue to look for ways to tackle access to credit and also address these affordability challenges, again, I'm going to talk through some of the options to leverage our existing product suite. Some of those options include Home Ready. Home Ready has an innovative income flexibility and down payments as low as 3%, to help those low to moderate income borrowers. There's also home style renovation and home style energy. We believe that these open up housing opportunities by making fixer uppers, an affordable option, and then that also helps with long-term affordability and sustainability. And then lastly, HFA preferred, which is near and dear to my heart. This pairs features of our Home Ready product with flexibilities from local and state housing finance agencies. So I'm going to get started with Home Ready. For anyone on the call who is not familiar with Home Ready, it is our flagship affordable product. And again, it's our low down payment mortgage product designed for credit-worthy low to moderate income borrowers. Here we have some of the benefits of Home Ready. Again, there are income flexibilities that are unique to this product. Acceptable income sources permitted only for Home Ready loans include rental income from a one-unit property with an accessory dwelling unit, so an ADU. And also border income may be used to qualify a buyer under Home Ready. As you're aware, and as also Brian alluded to, we have a focus on very low income purchases. So those are the VLIP borrowers that Brian had mentioned in his presentation. Fannie Mae had also rolled out an incentive in February. So we announced a temporary enhancement to our Home Ready product. This enhancement also includes a $2,500 loan level price adjustment, so an LLPA credit for those very low income borrowers. And the borrower must have total qualifying income less than or equal to 50% of the applicable area median income, the AMI, for the subject property's location. We are also requiring these funds to be used for borrower benefits. So they must go toward down payment or closing costs. And those closing costs can consist of, borrower paid MI. So in keeping with Home Ready's mission, it does have income eligibility requirements. So Home Ready loans must be less than or equal to 80% of the AMI for the property's location. This includes properties in low income census tracts. When determining whether a mortgage is eligible under the borrower income limits, you all, lenders, must count the income from any borrowers listed on the mortgage note whose income is considered in evaluating the credit worthiness for the mortgage loan. We provide tools to assist with AMI, and we've made our AMI lookup tool accessible either on desktop or a mobile device. And I would encourage you all to visit fanniemae.com/home ready, and you can take a closer look at our AMI lookup tool if you have not already done so. One thing that I forgot to mention throughout the presentation, I'm gonna be directing you to various points of Fannie Mae's website. I will be providing all of those links to Debbie in the deck, so you'll have access to again to all the directions that I'm sending you all to our website. So for Home Ready purchase transactions, excuse me one second. My allergies are acting up, and I could feel a little bit of a cough coming on, so forgive me.
What?
Oh, are we good? I thought I heard something come out of the.
We're good.
Okay, so for Home Ready purchase transactions, if all of the occupying borrowers are first-time home buyers, then at least one borrower must complete a homeownership education course from a qualified provider, and this is regardless of the LTV. So Fannie Mae's HomeView can be used to satisfy the homeownership education requirements. HomeView gives first-time home buyers a clear view, no pun intended there, into the home buying process. And HomeView is now available in both English and Spanish, and it is also available on desktop or mobile apps. One of the things that I like most about the course is the ability to track progress, pause, and resume anytime, anywhere. If you haven't had a chance to take a look at the actual course, I would encourage you all to log on to our site. You can take a look at the home view video, or you can also go through the course content yourself. I'm sure we can all agree that low down payment mortgages are a great solution for helping borrowers achieve homeownership. But for some of these borrowers, even finding a 3% down payment can be a challenge. So fortunately, in many cases, Fannie Mae allows funds for all or part of the down payment and closing costs to come from a variety of sources. So we allow three primary sources of closing cost and down payment assistance. The first being a gift, and that gift can come from any individual who's related to the borrower by blood, marriage, domestic partnership, adoption, or even legal guardianship. Next, we allow grants. Those grants can come from employers, municipalities, various nonprofit organizations. Uh, Lenders may also offer down payment assistance grants under certain conditions. And then community second mortgages. These can come from many of the same sources as the grants, but a second lien must be placed on the property. And although Fannie Mae does not purchase community seconds, we do purchase first mortgages associated with those seconds, and we do support that market. So to further assist in finding community seconds and grants, we've partnered with a third-party resource to assist borrowers in finding these funds. This resource is on our website. Borrowers can learn more about their down payment and closing cost assistance options. It's at fanniemae.com/down payment. The web page includes a research tool where borrowers can determine if they might be eligible for down payment fund programs. All they have to do is answer questions about the home that they intend to buy, their household income, and there's several other key questions. But once they answer those questions, the tool will look for matched programs that might be available to them based off of their unique situation. So moving on to HFA preferred, again, near and dear to my heart, working with state and local HFAs. I wanted to make sure we spent some time covering, this special product. We are proud at Fannie Mae to partner with HFAs. We have a long-standing relationship. Some of our accounts go back well over 30 years. We support We're proud to support affordable housing in the HFA's communities. And again, we call the specific product HFA Preferred. It's our low down payment product available exclusively to eligible housing finance agencies, and it is for the approved lenders in their network. With HFA Preferred, borrowers can purchase a home with as little as 3% down payment with no first-time homebuyer requirement. HFA Preferred also permits flexible sources of funds, including gifts, grants, community seconds, even cash on hand. These can all be used for the down payment and closing costs with no minimum borrower contribution required from the borrower's own funds on a one-unit property. HFA Preferred also allows for reduced private mortgage insurance, PMI coverage requirements for loans less than or equal to 80% AMI. And LLPAs, so loan level price adjustments, are waived for all HFA preferred loans. It is important to note that certain PMI coverage LLPAs may still apply if that borrower is over 80% AMI. So HFAs are also community second providers, and they do set their own borrower income limits, as well as homeownership education requirements. So homeownership education is required for at least one borrower if all of the occupying borrowers are first-time home buyers. HFAs can establish the homeownership education content requirements, or they can leverage Fannie Mae's HomeView to meet that requirement. I also wanted to spend some time on an overview of our duty to serve work and how that intersects with various groups in the community, such as nonprofits, HFAs, and CDFIs. So I know Brian he planted the seed, so to speak, about duty to serve. So for anyone who's not familiar with the program, Duty to Serve was issued through the Federal Housing Finance Agency as required by the Homeowner Economic Recovery Act of 2008. So to Brian's point, the rule directs Fannie Mae and Freddie Mac, so both GSEs. We are both directed to improve access to mortgage financing for those of modest means in three housing markets: manufactured housing, affordable housing preservation, and then rural lending. So both Fannie Mae and Freddie Mac have a duty to serve plan. In our plan, affordable housing preservation covers a range of activities, including energy efficiency, distressed and real estate owned properties, so REOs, as well as shared equity. We have several options that fall under AHP, so that's the Affordable Housing Preservation. A few of those include energy and water efficiency upgrades. These help decrease utility bills, contributing to the long-term affordability of a home. I myself, as much like Brian, my folks had oil heating. We also had kerosene heaters. So when that oil heating did not help cool the whole or help warm, the old farmhouse, we had to get out our kerosene heaters, and that was not always a fun chore to refill those heaters. So again, those energy and water efficiency upgrades can help with those utility bills. They can also make homes more comfortable and safer, leading to a decrease in health issues associated with allergens. And lenders can also benefit if the delivered loans are also a home style energy mortgage loan. They may be eligible for an LLPA credit. Moving on to distressed properties. So loans for the acquisition or rehabilitation of distressed properties. These provide affordable homeownership opportunities. They also provide liquidity for lenders, so for their own REO portfolio or short sale financing options. And in some cases, they may be eligible for CRA credit. And then lastly, shared equity programs are also under our affordable housing preservation. So there are a lot of shared equity opportunities in the Commonwealth of Massachusetts to help low to moderate income borrowers. I'd like to give a special shout out to Massachusetts Housing for the work that they have been doing with their Commonwealth Builder program. They have been a great partner and resource, not just to the lenders and the borrowers that they serve, but also to Fannie Mae on their duty to serve efforts. So I would encourage you all to, if you are not already partnered with Mass Housing, to take a look at their Commonwealth Builder program and these shared equity opportunities.
Can I interrupt you for just a second and ask a
Sure.
question?
Sure.
If you are talking about this area and we have questions, do you want me to give you what the questions are, or do you want me to just take them at the end?
Why don't we take them at the end if that's okay?
Okay, you bet.
All right, perfect. And I think Anita, she's manning the battle stations for the chat. So if anything comes in through the chat, I think if it's okay with you, she can answer those questions directly in the chat as well.
Sure, absolutely. Thank you.
You got it. So shared equity programs, they preserve affordable homeownership opportunities by allowing borrowers to purchase homes at or below market prices. In exchange for this, borrowers agree to sell that property only to other income qualified buyers at contractually limited prices. So under this structure, these programs provide a path to homeownership for many low to moderate income home buyers who very well may have not been able to afford a home without a shared equity program. We are also contributing to efforts to increase liquidity for shared equity programs and help address challenges of industry standardization and loan underwriting burdens that these loans may present. You can find shared equity programs that meet our requirements and help simplify your shared equity program review by using the certified shared equity program list that is on our website. And again, I will provide the link to our shared equity programs as well as an overview of shared equity as a whole. For today's session, I wanted to take a closer look at homestyle renovation and homestyle energy. And then I'm also going to touch on an update that we made to the guide around sweat equity as well. Debbie, I'm hearing some background noise. I don't know if it's possible.
Can everyone please mute your phone? Let me just see if I can work on.
People have done Accutane and it didn't even work on them.
Awesome. I think it's okay.
Okay.
Thank you. So as I touched on in the beginning of the presentation, right, affordable supply, top of mind for everybody. We all know the challenges. Homes are aging. I think the average age of a home in the United States is over 40 years old. There is that lack of new affordable inventory. New affordable home production is not keeping pace with demand. Builder costs are up. There's the conversion to rental units, so that's removing inventory for purchase for affordable supply. And then lastly, turnover is just at a 30-year low. We all know that the issues here. Americans are just not moving the way they used to be. So we see home style mortgages as a way to help you all grow with today's market. And I wanted to focus on specific product requirements and guidelines for home style renovation mortgage loans. Uh, so lenders must only obtain special approval to deliver these types of loans to Fannie Mae prior to the completion of renovation work. If a lender delivers home style renovation loans to Fannie Mae after all of the renovation work is complete, then no special approval is required. So I think that's an important distinction to call out today. To further help with affordable supply, home style renovation loans are available for both purchase and limited cash out refis. Again, to Brian's point, refis have dried up, but you never know. Someone may need to consolidate some higher interest debt. So in order to help, again, the product is available for both purchase and limited cash outs. So you can refinance a mortgage on an existing home to make renovations using lower cost mortgage financing versus, let's say, credit card debt or home equity lines. Home style renovation loans, they're simple, they're flexible. We believe they're priced right. Funds can be bundled into the borrower's purchase or refinance mortgage under just one application. Those renovation funds can be used for any renovation, energy, water, or resiliency projects. And upfront draws of up to 50% of material costs. They can help borrowers start projects without spending out of pocket. And borrowers can qualify for a CLTV up to 105% with eligible community seconds. Remodeling is not the only way to use a home style product. So home style energy mortgages, these may also be used for home energy improvements. So home style energy enables borrowers to bundle energy, water efficiency, and resiliency improvements into one purchase or refinance transaction. It's also important to note there is no special approval needed for home style energy delivery to Fannie Mae. And some best practices that we have seen are the ability to refinance existing PACE loans or energy improvement debt. We've also seen lenders, create strategic partnerships with solar vendors or home improvement companies, as well as partnering with realtors that are marketing older homes. Moving on to sweat equity. Last year, February, I believe it was February of 2023, we made a guide announcement expanding the circumstances and limit to which sweat equity may be used. We further defined program provider requirements, and we also defined how to calculate that contributory value of sweat equity labor. So we believe that these changes will all allow more borrowers to use sweat equity as a source of down payment, while also providing lenders, you all, with the additional resources to ensure nonprofit partners meet our eligibility guidelines. So sweat equity allows borrowers to contribute to their home's value through volunteer labor. This further helps borrowers build equity. Sweat equity can also be combined with community seconds, resale restrictions, and shared equity options to put homeownership in reach of more borrowers. So sweat equity provides flexible assistance options. And then sweat equity can also be difficult to evaluate. So that's one of the reasons why Fannie Mae requires lenders to work with an experienced nonprofit to ensure that hours are properly tracked and that those hours are converted to equity. So that partnership makes it all possible. So we feel that offering sweat equity as part of an affordable lending program may be easier than a lot of folks think. Here we have outlined 4 of the steps of turning sweat into shelter. I'm not going to focus on all 4 of these steps, but there are 2 steps that I want to talk about today. So I want to draw your attention to step number 2. It's important to note that the value of sweat equity can include labor from volunteers who are not the home buyer. And the home buyer they can accrue sweat equity by supporting the nonprofit on projects unrelated to their new home. So that's something that sometimes folks overlook. And then moving on to step number 4, if the nonprofit has adopted a shared equity model or resale restrictions such as community land trusts or deed restrictions, there very well may be additional underwriting requirements. We would encourage everyone to learn more about shared equity and sweat equity on our website. You can go to our singlefamily.com website and search under underwriting, originating, and underwriting. And again, I will be providing all of these links in our deck. So I've talked about many of our affordable options. What I'd like to do now is take a closer look at you all's origination process and how DU can help you and your borrowers. For today, I'm going to focus mainly on the enhancements and some newer innovations that we've made, to help address access to credit. So Fannie Mae is continually focused on modernizing the mortgage finance experience and exploring new ways to help our lenders open more doors for these aspiring homeowners in a responsible and sustainable way. We remain committed to expanding these opportunities for those who are ready to purchase a home. DU, desktop underwriter, and also desktop originator, so DU and DO. Our feeling is that these make lending simple. They both streamline lending so that you all can take advantage and obtain efficient underwriting recommendations that align with your processes. You can receive fast and dependable automated underwriting options for purchase and refinance loans, as well as getting action-oriented and detailed messages via the DU underwriting findings report. And lastly, we're focused on enabling you, the lenders, to qualify the most potential borrowers with these enhancements, leveraging data validation. So I'm going to cover some of the newest enhancements that we've made in DU. First and foremost, we're focused on helping lenders increase home ownership opportunities and also simplify your underwriting process for loans where no borrower has a credit score. So this includes updating existing eligibility criteria for loans where no borrower has a credit score in order to align with standard eligibility criteria. So you're able to use borrower permission bank statement data to enhance the DU risk assessment, thus simplifying the underwriting process by providing an automated option for lenders to meet the selling guide requirements in order to document these non-traditional credit sources. So DU can do a risk assessment with an asset verification report. This can have some positive results for borrowers, especially those with little to no traditional credit sources. When a borrower has no credit score, and when a 12-month asset verification report is submitted in DU, the report may be used to satisfy the non-traditional credit source documentation requirements per the selling guide, or the borrower may manually document 2 sources of non-traditional credit, and at least one of those sources must be housing related. So here's how cash flow assessment works. To participate, lenders order an asset report from a Fannie Mae approved vendor. The list of approved asset vendors is available on our website. From there, the first step is lenders educate their borrowers about the verification of asset process, and you have to get borrower consent to order that verification of asset report. Next, you order that verification of asset report with 12 months of asset data from an authorized report supplier. That supplier will then send the home buyer a link to a secure portal, and then lenders enter the reference ID in DU. And lastly, you'll review the DU underwriting findings messages to see if the bank statement data has been considered in the recommendation. So another feature is that DU can help assess loans where there are multiple borrowers for a home ready loan. And it allows for the use of an average median credit score in place of the traditional representative credit score This is to determine whether the minimum credit score requirement is met. So this is not for pricing. This is to make sure that that minimum credit score is met. So the average median credit score can help when one of the two borrowers has weaker credit. Traditionally, the lower of the two borrowers' mid-score would be used. You can see here in scenario number 1, we have a borrower that would not have met the credit score requirement when using the traditional representative credit score. But once you did that that median score, we were able to get a 656. So there was a 619 and then a 693, and then that resulted in a 656 qualifying score. One of our newest features and enhancements in DU is positive rent payment history. So you may have heard this, in the news. I know that this has been top of mind for a lot of folks for many of years. But positive rent payment history can be used to help underserved first-time homebuyers qualify for a mortgage. According to our research, lenders factoring in first-time homebuyers' history of consistent rent payments can be a significant difference between applicants qualifying and not qualifying for a mortgage. So there is some key criteria necessary for you all to consider when determining whether a potential buyer can be eligible for positive rent payment history. So the borrower must be a first-time homebuyer purchasing a principal residence. They must have a credit score of at least 620. So non-traditional credit is not permitted for this enhancement. They must have been renting for at least 12 months and have rent payments of at least $300 or more per month. And they must have bank statements that document the most recent 12 months of recurring rent payments. So next I'm going to cover some of our newest innovations and then policy updates. So one of the latest innovations that we have rolled out is our income calculator. I remember back from my loan officer and processor days that self-employed income was always a challenge. So at Fannie Mae, we have come up with a way to increase certainty of loan quality for home buyers with self-employed income. So this is designed for flexible implementation before and after making a DU submission. It returns an instant response without additional delays in loan processing. And at the time of delivery, no special feature codes are required. And then two of the policy updates from last year that I want to highlight for today is first and foremost the increase of LTV ratios for loans on a 2 to 4 unit principal residence. We believe this can help lenders reduce down payment costs and help create more affordable options for renters. And then DU removed the number of borrowers on a loan as part of the risk assessment. So this is intended to help increase mortgage access for a growing number of single heads of household. And then the latest innovation is our DU early assessment. So this innovation enables you all to give borrowers more confidence earlier in the process. It provides a DU conditional recommendation as part of the lender's pre-qualification process for conventional loans. It accepts a single soft pull credit file, and it also accepts a reduced data set for the information. It enables the use of the same case file ID from pre-qualification through the loan application and delivery. And I'm going to spend a couple minutes here just to talk to you all about how to get started. So you'll go to our website, fanniemae.com, and review the lender readiness checklist for key considerations and implementation, and to see if this innovation is a good fit for you all. Then you'll contact an approved credit information provider. These providers set up a separate credentialed credit account for soft credit pulls. And then lastly, you'll submit a request for activation to Fannie Mae. There is a lender activation request form for DU early assessment. And again, I'll provide all of these links to everyone so that you can easily go in and see whether or not this latest innovation is a good fit. It's also important to note that at the time of application, the case file must be resubmitted to DU with a standard tri-merge credit report. So again, you all should work with your credit reporting agencies to ensure that you meet the terms and conditions prior to requesting a soft pull report. And then again, I would encourage you to take a look at that lender readiness checklist. So we also provide a lot of resources that are available on all of our products, but specifically, some of the products that we discussed here today. This is on our website at fanniemae.com under mortgage products and options. So you can reference borrowers without credit scores. The site includes fact sheets, product comparisons, FAQs, among other helpful tools. You can also find free customizable marketing materials at our marketing center to help you all market the product. And then finally, there's helpful information about HomeView and what customers should expect from our home ownership course. So we encourage you to go in, take a look, bookmark the site for easy reference. And then lastly, our Learning Center at Fannie Mae is also another great resource for lenders. Here, you're able to see more information about some of our affordable products that we talked about today, but then also the entire suite of affordable products and those features. You can also learn how to use Collateral Underwriter, and then you also have the ability to explore video content, interactive guides, and the various interfaces that we offer at Fannie Mae. So again, I'd like to thank the Massachusetts MBA for this ability to speak with you all. I'd like to thank Freddie Mac for the ability to partner on this presentation. But most importantly, I would like to thank all of you for the hard work that you're doing and the commitment that you are showing to all of the borrowers, in the Commonwealth of Massachusetts, but also this focus on affordable and those low to moderate income borrowers. Thank you again.
Thank you both. So Anita has been faithfully typing away all of the answers. And so what I don't know is, I think you've caught them all as far as specific Fanny questions, I think. Do you think, I think you've done a really good job. And I
Yeah,
think,
I'm sorry, I did catch them all. I know there was a bunch of questions around like if deed restricted properties are eligible. And the answer is yes. We do have some different resale property, resale restricted property eligibilities that are listed on our website. Did post that in there. And then there was questions around the energy efficiency mini splits or solar panels. We do have a link on our site to Energy Star related products, but particularly with any energy efficient improvements, it's basically that our energy related improvements may include any improvements that are either that reduces the home's energy or water usage. And so improvements such as solar panels would be eligible. And then averaging FICO scores. DU automatically does that on certain transactions. So.
okay. So I might, if it's okay with the two of you, bring Lori and Brian back. And let's spotlight everyone to see what other questions we might have for all of you at the end. So I know I wanted to get back to weddings and wedding deposits and all of that. And I know that you can tell people this is what you do when you're doing a deposit, and they sometimes will listen and sometimes not. So I know I used to say, now, before you make that deposit, could you maybe just take copies of everyone's checks? No. They forget. Or so 1,500 is the magic kind of, number. So would you advise people, what would you advise? Don't make any deposit over 1,500, or what would you advise for those weddings or graduation parties?
Well, I know for Freddie Mac, anything $1,500 or more, you simply need to get a gift letter from the provide, from that kind family or friend that has gifted you with $1,500. Anything below that, yeah, often. I know my bank allows me to copy or print out everything I've deposited. So there may be a technology solution wherever your borrower is banking when they make that deposit. But if there's ever a question, again, 1-800-FREDDIE, great resource for some creativity in how to document a loan file. Creativity in a good way.
Yes.
Yeah, and for Fannie Mae, I say that wedding gift funds are acceptable. And it's not a magic number for us. It's anything that's considered a large deposit, and large deposits for us is anything that is over 50% of your monthly income. So if there's a deposit that's larger than 50% of that, that would be considered the large deposit, and would need to be documented in a wedding case or graduation. The borrower, you have to use your own, judgment. You have to use responsible, when you're looking at it. But a copy of the wedding invitation or graduation party invitation would be acceptable with the borrower's explanation.
Yeah, I think documentation's key, right? And as much as I'm
Right.
surprised to hear that folks aren't listening or taking advice when they're making those deposits. Sorry, it's a little cynicism here. Documentation is the key, right? Tell that story. To Anita's point, right? Save a copy. Everybody's going to save a copy of their wedding day announcement, or their save the date, right? If they have an engagement party or whatever it might be, right? So tell that story so that it further helps with the documentation. So I think that is the key.
Okay, perfect. I know that there are some comments in there about income limits, and they're just not high enough for anything to be qualified for. I know one person in particular said, are there any more programs on Cape Cod because the income limits are too low? I don't know if there's anything, and I know that our HFA partners are on here tomorrow. I don't know if you have any thoughts on the income limits or anything you wanted to comment when it comes to that.
Well, we know it's a huge challenge, right? Even in rolling out, both agencies rolling out the VLIP credit. We understand, that's serving that less than 50% AMI market is becoming harder and harder. With all the things that we discussed today. Unfortunately, we don't set the income limits. But I would say that an organization like Amass Housing or any other local or state programs, that you can potentially talk to, they would probably be a good resource. They tend to set their own income limits. So again, partnering with organizations like that and just talking through the different programs, would probably be my best advice.
Yeah, well, that was well said, Robert, and I would agree with that. And we're certainly seeing it elsewhere around the country as well. And other high cost areas. It's a refrain, not just limited certainly to Cape Cod or other high cost areas within Massachusetts or New England. And then we kind of see the opposite of that in some areas too, where they may not be high cost areas, but areas where area median income is suppressed. And then when you take 50% of a very low number, you get a very, very low number. And then, just the challenges that home buyers may have just to be able to afford a mortgage from that standpoint. So, we wield the tools we have, and we're certainly open to creativity and working with folks on different ways that we can try to crack this nut and address the issues.
Well, and if I could just add that the HFAs, they have great down payment resources, and there's significant down payment assistance. And that's wonderful to help fill a little bit of that gap. But keep in mind, if the borrower it does not qualify for housing finance agency, or it's not maybe the best product, maybe a home possible with that 3%. Different sources can be layered in to create that down payment assistance. So look at your nonprofits, look at your towns and municipalities. They're getting in on the the challenge of affordable housing, and it benefits them because they have their infrastructure and their lower income uh, employees close to work. And so again, remembering that layering on where, yes, it does add a little bit of risk, but it's also allowing those borrowers that have worked so hard to save to maybe hang on to a little bit of their savings in the underwriting transaction. Their reserves are beefed up, but really in real life, they have they have their savings for when real life home ownership events happen. So keep in mind, layering is also going to be a key in down payment and closing cost assistance.
How wonderful you said that, Lori, because I am going to put in a plug for our part 3 of
Great.
and part 4 of our Affordable Lending Summit series, is that it's all about down payments and layering. It's amazing the resources out there from city, federal, state, just an amazing amount of resources. So on April 23rd, we're going to talk about that from an origination standpoint. And then soon afterwards, we haven't yet set the date. We're actually going to be looking at it from an operational best practices. When you're layering all those, how do you do it? How do you keep track? Like, how do you get them all to close? So we're going to be looking into that very important thing.
Yeah, sorry, just if I could add, right, and I know I covered it in my presentation, but again, that's why we developed that tool that home buyers can go, they can answer those select questions, and that tool will help direct them to all of the various programs that are out there. So not just one, right, to Lori's point, layering is key, and encourage folks to try to find as many different resources that they can, because they are out there in the market. So again, that's why we came up with that tool, so that folks can see all the unique things that may be available to them. If they're a first responder, if they work in the healthcare industry, right? It's limitless of all the different programs, that are out there.
Absolutely. Maybe one question that might not be fair to any of you, but the new credit score models that are coming out, supposedly we're going to be able to reach more consumers with those models. Are you excited about them? Okay.
So no, I don't want silence to be taken as we're not excited about it. It's not an area of focus for Lori or for me.
Yeah.
So I don't want to go on record, one way or the other, as saying I don't feel like we're qualified necessarily to speak to that. But I would say more generally, we are certainly excited about any ways where we can help meet the housing needs and financing needs, working with you, working with Mass MBA, working with all lenders gathered here, right? So from that standpoint, yeah, I mean we want to find ways of trying to, like we say, Freddie Mac, make home possible, and so I'll address it from that 30,000-foot level, and then kick it over to Robert so you could be uncomfortable with the question.
Yeah.
Oh, sorry about that.
No, look, it's okay. It's well said, Brian. So there's still a lot happening, and I guess the one thing that I would say is I would encourage everyone on this call to attend a listening session. So you can talk to your account executive either on the Fannie Mae side or the Freddie Mac side. They may be able to get you that invitation. I don't know if Mass MBA is hosting any of those listening calls, but FHFA is listening, so they want input from as many sources as they can get for this. And to Brian's point, right, like we support anything that's going to help the low to moderate income borrowers and just help the overall lending ecosystem. So in that regard, we're excited. I think anyone who's worked at the GSEs for any length of time knows that change is the one constant. So you always have to be on your toes. But again, I would encourage everyone to make your voice heard, right? You all are the ecosystem. of lending. So I would encourage you to attend those listening sessions if you can.
Perfect. We have just a few more comments, questions in the queue. We're going to go back to those weddings. So you've got large amounts of cash that are, and it's not reasonable to ask for copies of checks. So mother of bride speaking, lots of them are given in cash. What do you do?
It's funny because it is wedding season, right? So I'm thinking that's where all
Yes,
this is coming from. So spring has sprung.
yes, yes.
Well, I'd say as far as if they're depositing it in one lump sum and it is considered a large deposit, it's like Robert said, it's all about documentation.
Yep.
Try to get gift letters. I want to think one of the things is the transfer of funds. I mean, you just have to really use underwriter due diligence when looking at cash. My camera's going all fuzzy here. Okay. I don't know, Brian or Lori, on your side, what would you say?
Yeah, I mean, from our side, and Laura, you spoke to this with that 1,500 cutoff. If you've got a number of gifts that fall under that $1,500 level, which I would think would for the most part be the case, you shouldn't really have an issue. It's going to be the larger gift amounts, and hopefully that the number of those larger gift amounts doesn't make it untenable to get the documentation that would be required.
And when in doubt, 1-800-FREDDIE. They're happy, the underwriters are happy to talk through specific scenarios. They can go into Loan Product Advisor, see what you've entered in, and really provide some guidance as to how to interpret what LPA is providing, and then also how to document that loan file.
Great. And then one last question, I think it might be the last, is Title V, septic system repairs, replacements. Are those allowed?
Yeah, for choice renovation, we are not prescriptive as to what the renovations can be. We just want to make sure that we're getting that borrower into the best possible situation with that home. Because if they're happy in the home and they can live in it in a healthy, as Robert said, it's not just cosmetic, it can also be health related and mechanical and structural. But as long as it is really something that the borrower needs to make that house their home, then it's acceptable.
Okay.
And that
I
would
saw
apply same with
Debbie.
Fannie.
I saw Debbie. There's also a question out there around uh, addition of a second story, and would that have
Oh,
to be
yes,
considered an
yes. Thank
ADU?
you.
So I just wanted to pull that one out as well. So go back to the what defines an ADU, right? So if you're adding a second story and it's going to have a separate entrance and a separate kitchen and so forth and so on, then yeah, it could be characterized as such. But I think either way, the way you would be looking to finance it, whether it's getting characterized as an ADU or not, would be through some form of renovation financing, right? And then it's just the cost of that improvement would have to fall into what's allowed through the from the Freddie Mac side, the choice renovation terms in terms of does it fall within what we would allow?
And is that the same for Fannie?
That is the same for Fannie.
Okay,
It would
perfect.
be our home style renovation product and the ADU. I mean, then again, back to the guide as far as what's allowable for ADU. So
Okay, perfect. All right. So I don't see any more questions coming in. And so I will remind everyone that we will be forwarding out the recording link as well as the presentations. And I would just again like to say thank you to both Fannie Mae and Freddie Mac for the time, to our speakers, for being allowing us to put on this very important program. So,
And Debbie, thanks to you for the invitation, for your hosting us today, your guidance and helping to put this together, and the opportunity to participate, because this is, it's about us reaching you, reaching all of you in the London community gathered here today, to make connections and to bring resources to bear in order to make possible what we're all trying to achieve here.
Thank
Yeah,
you.
agreed. Couldn't do this without all of you. So thank you for the opportunity.
Thank you. And we will see you soon. Thanks so much, everyone.
Thanks, everyone.
Take care.
Thank
Take
you.
care.
Bye-bye.